All right, Chair, the floor is yours.
Welcome. Welcome to 2021 annual meeting of the Central Bank Research Association. This is session 25. The theme is Reshaping the Economy, Blueprints and Policy Challenges. First of all, I'd like to thank the MIT Golub Center for Finance and Policy for hosting this annual meeting, and also thank the Leibniz Institute for Financial Research for its continuous support. So this session is organized by the Bank of Japan's Institute for Monetary and Economic Studies. And this session covers a wide range of topics that help us consider reshaping the economy. The topics include digitalization and inequality, the first paper, monetary policy strategy, second paper, climate change, the third paper, and social capital, the final paper. Each presenter has 30 minutes, including Q&As. I strongly encourage all of you to engage in discussion. You can ask questions or make comments using a chat function or using a raise hand function, so I will pick you up later. Okay, the first paper is Digitalization, Heterogeneous Agents, and Wealth Inequality by Takuji Fueki, Bank of Japan. Now the floor is yours. Please start sharing your screen.
Thank you. Looks nice.
Yes.
Okay.
Looks good.
Okay, thank you very much. So I'm Takuji Fueki. I'm talking about our preliminary results. So comments and suggestions are very welcome. The title is Automation, Heterogeneous Agents, and Inequality. So this is a joint work with Ichiro. He is my boss and he's attending this session. Fumitaka will work for the IMF and he's also attending. So I'm assuming that he will answer all questions from you on the floor. So please feel free to give us comments and suggestions. And finally, Makoto is a professor of economics at the University of Tokyo. So first of all, I would like to present two motivating facts for this project. So first fact is wealth concentration in the US. So this table shows the shares of households in the top 0.1%, 1%, and 5%, and 10% of the wealth distribution. The bottom 90% of the wealth distribution is also shown. So wealth means consolidated household portfolio. So comparing 1989 with 2019, you can see that the share of top increased about 10 percentage points. This suggests that wealth has been concentrated at the top in the US over the past 30 years. Second fact is about saving. So some recent papers stress saving glut of the rich. So that is, wealthy people save more than poor people. In other words, the saving rate of households at the top is higher than those at the bottom. So given these facts, I think it is natural to ask, why does wealth become concentrated at the top? How does saving behavior translate into the concentration of wealth at the top? So this is what we would like to address in this project. Our answer is that we may have two potential drivers. First one is differences in risk-taking behavior. And the second one is advances in digitalization and automation. I would like to call it DA for short. Before moving on, let me just define DA in this project as follows. DA is a capital which can substitute human labor in production. Also, investment on DA is high risk, high return. So this is empirically supported by this paper. So we think differences in risk-taking behavior on DA may drive the wealth concentration. So more recently, this may be supported by anecdotal. So just remember Google, Amazon, Microsoft, Facebook, and so on. So many of the rich are people who have actively invested in the development of high-risk, high-return DA technologies. So they would become rich by investing DA. So take a look at these figures. The upper panel shows the top 10 richest people in the US in 1990. So the fourth column represents their source of wealth. So as you can see, they got wealth from finance or financing or so on, so which may not be closely related to DA. But when you look at the second table, you have different views. The source of wealth comes from DA for many of the rich. So this may indicate that they took risks on DA investment. When they succeeded in investment, they become richer. So given these considerations and anecdotal, we are thinking about the following mechanism to generate the wealth saving inequalities. So suppose households are heterogeneous in preferences for risks. So this is not so strong assumption, I think, because this is supported by many papers, and I will talk about it later. For now, just let me assume this is the case. So then household with low risk aversion or risk lover would love to take risks. So also they have low time preference, they will save. Then they would like to invest on risky project. Here it is DA capital. Then they can enjoy high returns from investment on DA capital when DA is more advanced and their projects succeed. The obvious consequence is that they become rich. So since they have low time preference, they will save more to invest on DA technologies. But unfortunately, some of them may fail on investment and then they become poor. Oops. So on the other hand, households with high risk aversion do not take risks. Then their investment on risky DA capital is very small, and they rely more on wages and returns from safe assets. This implies they cannot enjoy gains from advances in DA. Also, since DA will substitute their labor, the wage income may decrease. Then they become poor. Hence, through this mechanism, differences in risk-taking behavior on DA may drive the wealth-saving inequalities. So the goal of this paper is formalize this story and investigate how important DA and risk-taking behavior in accounting for wealth concentration and saving growth of the rich. I think we have three contributions. First, a model with heterogeneous attitude toward risk is not new in the literature, but we extend the model to include DA capital, and we can capture the idea that DA introduces inequalities. Second, we will quantify how advances in DA affect the wealth-saving inequalities. Third, we seek to investigate macroeconomic consequences of advances in DA within this model. So we skip. So what we find? So we calibrate our model to the US economy. Roughly speaking, the model can quantitatively account for the observed wealth distribution in the US under reasonable calibrations. Based on this model, we find that 10% increase in DA productivity causes about 3% increase in wealth at the top. Also, saving rate at the top increased about 0.3 percentage points. This suggests that some of the concentration of wealth and saving at the top may be explained by advances in DA. With respect to macroeconomic consequences, Advances in DA lead to a decline in labor share, which is consistent in the literature, and it increases output, consumption, and investment on DA. Okay, so this is what we find. So I would like to talk about a model very quickly. Our model is based on a standard neoclassical model, but as I mentioned before, I introduced two ingredients. We derive our results by combining the literature on DA with insight from research on household heterogeneity in preference. First ingredient is DA capital. So this is a capital which can substitute for human labor. So also DA capital is risky. So that is, we assume that return on DA capital is subject to idiosyncratic shocks on return on the DA capital. So this is only source of uncertainty in this model. So introduction of this kind of capital is extensively analyzed by Asimov and Berg and others. So we just follow them. Second, households are heterogeneous in both risk aversion and time preference. This is not new in the literature, as is mentioned in Nirei et al. The literature finds that this heterogeneity is key in explaining the distribution of wealth. So we just combine these two literatures. Then, so since the model is standard neoclassical model, I just want to show you how two ingredients are introduced. First of all, let me show you household heterogeneity. Households optimally solve their savings, consumption, and the portfolio problem to maximize this utility. This is just a standard Epstein type utility, but we assume that time preference, low, and risk aversion, gamma, are heterogeneous across households. So some people may have high risk aversion, but other people may have low risk aversion. So this is household budget constraint. Household hold two types of assets, risky asset and risky DA capital. W is household wealth. Theta represents the fraction of wealth invested in DA capital. Then this term captures returns from investment on risky capital, and this represents returns from risky assets. So with respect to risky DA assets, the aggregate return is deterministic. So, but this is subject to household-specific rate of return risk. Hence, this term captures idiosyncratic risks of rate of return to DA capital. So this is only source of uncertainty in this model. And again, the assumption that DA capital is risky is empirically supported by some paper. So let's move on to farm. So they use three types of input: human labor, traditional capital, and DA capital. So the important assumption is that DA capital is substitute of human labor, although human labor is complement of traditional safe asset. The production function follows nested series function as follows. Final goods Y is produced by traditional capital, and B is composite of DA capital and human labor. And again, DA and human labor are substitute. So phi represents the elasticity of substitution between them. So then other part of the model is very standard. That is, we can define the stationary equilibria given household maximization, farm profit maximization, and market clearing conditions. So based on this equilibria, we are focusing on stationary equilibria. We can have some quantitative implications. So before that, we need to set parameter values. This shows it. So most of them picked up from the literature. So what I would like to mention is twofold. First one is about risk aversion, gamma, and time preference, rho. So just for simplicity and practicability, I assume that values on risk aversion are 0.5 or 3. Also, time preference is 0.0275 or 0.0325. So we have 4 types of households with respect to risk aversion and time preference. That is household with low risk aversion and low time preference, and household with high risk aversion and low time preference, and so on. Second, I would like to conduct comparative statistics. So I will examine how the wealth-saving distributions are affected by changes in parameters about advances in DA. So we examine 2 scenarios in addition to benchmark case. First, I assume DA productivity increase. This is called DA1. Second, I assume that the elasticity of substitution between DA and human labor increase. So this means that the range of tasks in which robots, automation, digital technology can replace human labor become wider. So this is called DA2. So I will show you several quantitative results based on this calibration. So first, we check whether the model replicates the distribution of wealth in the US. So we try to see if our model with benchmark parameter values can replicate the data observed in 1989. So please take a look at this table. So second column in the data is the data in 1989. And the third column is wealth distribution implied in the model. So in a model, it seems that the concentration at the very top is a bit higher than the data observed in 1989. But our model qualitatively and roughly speaking, quantitatively captures the distribution of wealth where we think. Then, based on this model, we conduct comparative statistics to examine how the wealth saving distributions are affected by changes in advances in DA. First, we look at how 10% increase in DA productivity change the distribution. Take a look at the 5th column, this column. So comparing with the benchmark, we find that 10% increases in DA productivity cause about 3% increase in wealth at the top. So differences between column 2 and 3 mean the concentration of wealth from 1989 to 2019 observed in the data. So since productivity in DA seems to increase over the same period, so some of increase in the concentration from 1989 to 2019 may be explained by advances in DA. Next, we look at the impact of 40% increase in the elasticity of substitution between DA and labor. So take a look at 6th column. So comparing the benchmark, we find that it also causes about 4% increase in wealth at the top. So I think DA seems to be more advanced and substitute for human labor more over the same period. So some of increase in the concentration from 1989 to 2019 may be explained by these advances in DA. So I would like to see who becomes wealthier as DA is advanced. So this table shows how each types of households are distributed across the wealth. So the second column shows top 10% wealth share and the bottom 90% wealth share for benchmark DA1 and DA2 as shown before. So column 3 onwards show a breakdown by types of households. So please remember there are 4 types of households in this model. So the second row shows that in the benchmark, the top 10% wealth share is about 63%, and the household with low risk aversion and low time preference hold about 24% of wealth at the top 10%. So many of the rich are household with low risk aversion and low time preference. So what is interesting is that the share of household with low L, gamma L increase as DA is more advanced. So on the other hand, the share is almost constant for other households, even if DA is advanced. So this suggests that households with low L, gamma L enjoy most of gains from advances in DA because they actively invested on risky DA project. So our model suggests this. So this figure shows the wealth distribution for each type in detail. The horizontal axis is log wealth. The vertical line means density. So red line represents household with high risk aversion. Blue line denotes household with low risk aversion. So this is based on the benchmark calibration. I show only for the benchmark case, but the implications are the same. So what I would like to talk about are twofold. So first, some of households with low risk aversion become poor. Look at this blue line. So because they fail to invest in DA. Second, households with high risk aversion are centered. So they invest mainly on risk-free asset and thus little dispersion in wealth. So let me wrap up. So wealth of households with high risk aversion are centered. On the other hand, households with low risk aversion can be the richest people, but unfortunately, some of them become poor. So let's move on to the saving.
Takuji, you have 3 minutes.
Okay, so this table shows saving rate for each household type. So what is worth mentioning is that households with low risk aversion and time preference tend to save more. It is about 15 or 16%. Given the distributions of wealth for each type of household and saving rate, we can show you some plots on saving rate against wealth. This figure shows the result. The horizontal axis is log wealth and the vertical line means saving. So red line means red lines mean benchmark and blue line the case of advances in DA. So what I would like to stress is twofold. First, you can see that this model may account for saving rate of the rich. That is, saving rate is higher when wealth is higher. So wealthy people save more. So please remember the distribution of wealth. In this model, the wealthy people are households with low risk aversion and low time preference, and they also have higher saving rate. So saving rate around here is high. Around here, there are many households with high risk aversion and high time preference. So same saving rate is not so high. At the bottom, households with low risk aversion and low time preference are around here. This is because they fail to invest on DA technology and use their wealth, but they have high saving rate. Hence, the saving rate around here is high. Second, you can see blue line is higher than red. So our model suggests that the advances in DA is the higher saving rate. So this shape of saving rate against wealth may be consistent with some findings by Benjamin Moore, but if we could have some comment and thoughts on this, that would be great. So with respect to macroeconomic consequences, I would like to mention that the DA, as DA are more advanced, output, consumption, and DA capital increase, but labor share decreases, which is consistent with the literature. So wrap up. So we find that two factors may be key to understand the wealth inequality, that is health heterogeneity in dispersions and advances in DA. I think we can use this model to have some implications for digital tax or other policy options in the future. So that's it.
Okay, thank you very much. So now the floor is open to audience for questions. So you can use chat function, or you can use raise your hand function, and so I can pick you up. So while audience is thinking, asking questions, let me ask you one or two questions. Takuji, first question is that, so you focus on increase in productivity of digitalization and automation capital.
Yeah.
But if there is an increase in traditional labor productivity or productivity in safe capital, what would happen? So that's one question. And also just for exercise, if there is an increase in riskiness in risky capital, that is digitalization, automation capital, what would happen to the economy? So that's the two questions I have.
Okay, so with respect to first question, I would like to do this exercise, but I think rate is more centered if productivity on safe asset increases, but I would like to check. And about your second question, so if the riskiness increases, the distribution is more, we have more dispersion on this distribution. So we may have more flat saving rate and a little more flat distribution for this wealth.
Okay, thank you. Looking at this table, I have another question. Why you have so high top 0.1% concentration in your model? So relative to data.
I think this is I think it's a puzzle. So we expect that more flat distribution for the top, but simulation results show that the concentration. So maybe we need some more constraint, such as borrowing constraints or something to get more flat distribution.
Hey, thank you. So still we have 1 or 2 minutes for questions. So it appears that Takuji's co-authors are participating. So if you may have some comments, just jump in.
So he will answer all questions, all difficult questions. So please feel free to ask him.
Okay, it appears no comments or questions anymore. So thank you very much, Takuji, for your great presentation. So please stop sharing your screen.
Okay.
And we are moving on to the second paper by Zoltan Jakab, IMF. The title is Monetary Policy Strategies for the European Central Bank. This is quite timely. As all of you know, yesterday, the ECB published the monetary policy strategy review. So Zoltan, the floor is yours. So please start sharing your screen.
Do you see my screen?
Yeah,
Everyone
it
sees?
looks
Okay.
great. Yeah.
So thank you for the opportunity to present this paper. As you mentioned, it's quite timely as the ECB has finalized this strategy review, but it's not just about ECB. We might think it's that there is also a constant rethinking of monetary policy for the Fed, for other central banks as well as the Bank of Japan. This is a joint paper with Chris and Jesper, and Chris is on the audience, so he might jump in and answer some of your questions, which I cannot answer. So the usual disclaimer holds on this paper. So what do we do? So the first and most important question is what to do in a low steady state real and nominal interest rate environment, especially in the euro area economy. In that case, if we have a low interest rate environment, the likelihood of reaching a ZRB, or passive monetary policy, in other words, is more frequent, and that poses some questions on monetary policy strategies to deal with this. To do it, first we start assessing the implication of a symmetric versus an asymmetric policy regime, especially when the effective lower bound, henceforth ERB constraint, is binding. To do this, we artificially generate long sample data through stochastic simulations. We call it unconditional distributions. Second, we also analyze the impacts of unconventional monetary policy tools, especially negative interest rate policies, forward guidance or lower for longer policies, and large-scale asset purchases. And the third is a more radical change in policy, changing the policy regime, like we analyze the implications for average inflation targeting or price level targeting. To do this, we build upon a workhorse DSG model, Smith Waters and CEE Cristiano et al. Models, as estimated for the euro area for the very recent period until the 19 Q4 sample. And the major departure from this model is that we drop the full rationality in expectations, and we follow, at least in spirit, Gabay-type behavioral approach in forming expectations. So households in the baseline model are behavioral, while in the baseline model, firms and labor unions remain rational. In the robustness analysis, we also show the impact when everyone is behavioral. We also compare our findings with the rational expectations model, and we found that most of the policy implication, although qualitatively a bit different in the two model versions, the ordering of regimes or the policy conclusions are quite robust. So as I mentioned, the major contribution is that we consider an estimated DSG model which addresses the forward guidance puzzle through behavioral expectation. Is it timely? Yes, we think it's timely. So as Daisuke mentioned, the ECB has published its strategy review 2 days ago. But historically, the formation of Eurozone policy, monetary policy, evolved such that in May 2003, the Governing Council stated that in the pursuit of price stability, it aims to maintain inflation rates below, but close to 2%. That suggests a little bit of asymmetric treatment of the 2% target. Recently, there were steps towards more symmetry, like in 2019 monetary policy statement, and more recently, 2 days ago, the strategy review. So what are the key findings? First, asymmetric policy formation would draw a large cost in terms of output, and unconventional policies cannot fully offset these adverse effects. There are sizable output gains in the long run, also with respect to the level of output and the standard error, I mean lower standard error, when forming a symmetric strategy versus an asymmetric strategy. Make-up strategies like average inflation targeting or price level targeting strategies in the long run increases output volatility a little bit, especially because the Phillips curves are estimated to be flat, and there is a prominent role for cost-push shocks, which posit a trade-off. So these are the long-run results. In the short run, that's what we call conditional simulations. We found that a full set of unconventional monetary policy tools are needed to improve the current outlook. And also that in the reaction function, it's necessary to, or it's advisable to drop the output growth term in large recessions. And we also found that the fully credible formation of average inflation or price level targeting strategies stimulate economic activity and help close the inflation gap in a few years' time. So the benchmark model, as I said, it's a workhorse DSG model with all bells and whistles like sticky prices and wages, real rigidities, variable capital utilization, fixed cost of production. And as mentioned, the major departure from this model is behavioral expectations in the spirit of the approach of Gabe. What does it mean? It means that the behavioral expected value of a variable is a constant times the rational expectation term. It seems like just a small modification, but if we move forward in the equations and solve the model, it has a strong implication. It means that future has less impact on current output than in a rational expectation model. We estimate this coefficient, and we estimate it to be much higher than usually used in the literature. We also found that this behavioral model, relative to the RE model, is superior in terms of fit, especially if we assume a low steady state real rate. The variance decomposition of our estimates suggests two things. First, markup shocks are the dominant factor in inflation development. And in addition, we have a quite flat Phillips curve. On the other hand, the risk premium shocks are more important in output and policy rate evolution. So what is the implication for this? In a low real interest rate environment, there is a notable trade-off between stabilizing inflation and the output gap. So following a positive inflation shock, the central bank has to accept sizable effect of drop in output gap to stabilize inflation. So that's a key feature of the model. The second feature, if we look at the impulse responses of the model, is that although the major real shock, the risk premium shock, is practically or quantitatively at least very similar across the red and the blue line. The red is the behavioral model, the blue refers to the RE model. This does not hold for the monetary policy shock. So monetary transmission is very different in the two models. In the RE model, monetary policy leads to a 1% increase in interest rate would lead to around 1.7% drop in output. While in the behavior model, it's less than half of it. The same applies for inflation. So what is the consequence for that? And here in this chart, we show a credible announcement of the central bank, forward guidance of having lower interest rate. So the implication is that with introducing behavioral expectations, we solve the so-called forward guidance puzzle. The forward guidance puzzle is that in a rational expectations model, if the central bank commits to a low interest rate environment for a prolonged time, it would lead to a high, implausibly high increase in output. That's certainly not the case with the behavioral model. So that's why we chose the behavioral model. I should also mention that part of the forward guidance puzzle is also solved in our RE model, because we assume a relatively low intertemporal elasticity of substitution. That also helps a little bit in solving the forward guidance puzzle. So that means that at the ZLB, when the central bank is stuck for a long time to have a low interest rate, but cannot go below that, means that the output cost of ZLB is less in the behavior model than in the rational model. And we will see it in the long run simulations as well. So first question, symmetric versus asymmetric strategy. How we did it, in the long run unconditional simulations and also in the conditional simulations, introduced a new term into the reaction function, a kinked term. So whenever inflation, expected inflation exceeds the target for, let's say, for 4 quarters ahead, there is an additional rise in the policy rate. We could not estimate this coefficient in our sample because only 6 quarters of the, let's say, 20 or more than 20 years of data point for the euro area exceeded the target interest rate, suggesting that there might have been some asymmetric formation of the policy. So after running 25,000 observation ahead with this model and drawing same random shocks, we found an interesting distribution of both the output gap and inflation. You can see there is a ZRB constraint, so there is a spike in the density of interest rate. And because of asymmetric treatment of inflation, the mean inflation is about 1.7%, the asymmetric policy rule. And that also gives rise to a downward skewness in output gap. So here is the table with all the results, and you can see that in both models, both in the RE model and in the behavioral model, ZRB is costly in terms of mean output. So its mean output is not 0, mean output gap, but minus 0.2 or minus 0.4 in the RE model. As mentioned, the ZRB is less costly in the behavior model than in the RE model because we have less of the forward guidance puzzle. The asymmetric formation, however, is quite costly in terms of mean output gap in both models, and it leads to, let's say, around 0.25% below mean long-run inflation. So the first conclusion is that there is a large negative output effect of pursuing such a policy, an asymmetric policy. So there are clear benefits in terms of moving for a symmetric formation of the monetary policy, because output volatility would decrease while inflation would be closer to the target. I skipped this slide, just mentioned that we also analyze whether unconventional policies can, offset this negative bias in output if there is an asymmetric policy. We found it was not enough. It helps a little bit, but it was not enough to drive back output gap close to zero. The next thing is a short-run simulation. So we took the 2020 Q2 data and ran a simulation, stochastic simulations with this COVID-type shock. In this environment, obviously, there were negative supply shocks and negative risk premium shocks. So if the ECB would use the estimated rule, standard Taylor rule with an output growth term, output would only gradually recover and inflation would go into a slight deflation with a quite sizable probability of large deflation. If the ECB would drop this growth rate term in the rule, that's our first conclusion, it would avoid deflation and output would recover a little bit faster. If, on the other hand, a forward guidance policy would credibly announce, and at the same time, the policy rate would be allowed to drop to -1%, that would help quite sizably with the output gap and also practically prevent deflation in the short run. With UMP policies, so large-scale asset purchases, which drive down the term premium, inflation would not drop too much and output recovery would be much faster. The same applies in the RE model, the rational model. If we look at the final panel, the right panel, the UMP policy, so output would have been recovered a lot and inflation gradually reaches the target. But the reason is different in the RE model. So with the estimated rule only, in this very bad and big, large recession environment, there's a huge downward risk to output and inflation. But the RE model, as we mentioned, both the forward guidance policies and the unconventional policies are more effective. So these negative bias would be offset by stronger unconventional policies. So the end result would be very much the same. So in other words, UMP policies are needed in this negative environment, this recessionary environment. That's a robust statement, but they are not enough to get the inflation back to target is a high probability in both models. So next, we analyze the benefits of potential new frameworks. Here we analyze average inflation targeting with two variants of that. One is with a standard reaction function to inflation, and one with a more inflation focused environment. We will find that this is a prerequisite to have a success in the AIT framework. And the second experiment is price level targeting when there is no bygones. So in other words, if there is a negative deviation from the target price level, the central bank should offset it in the future. And there are two variants of these policies, both permanent and a temporary. By temporary, we mean that the central bank only uses these makeup strategies when the shadow rate is lower than the effective lower bound. And the table on the next slide will show that regardless of the model, these makeup strategies are helpful in terms of output gap, the mean output gap, the level of output, and also help in inflation and reduce the variability of inflation. However, and yes, I should also mention that the probability of deflation is also lower with these makeup strategies. However, there is a difference between a permanent or temporary regimes. The temporary regimes are superior. So they both reduce the output gap variance and also increase the level of output gap, so decrease the distortion created by the ZRB. And they also reduce inflation variance, especially if we allow for a large focus on this inflation gap for the AIT regime. So temporary AIT or PIT regimes reduce the standard errors, and they harvest the benefits of a flexible inflation targeting in a normal environment, and the makeup strategy benefits from the when the rate is limited by the effective lower bound. And the second exercise with these makeup strategies is that we did the same short-term forecasting exercise following this big recession in 2020. And you can see that obviously the PIT is a very strong policy change. It would really create an overshoot in inflation and stabilize output. And AIT, average inflation targeting, is also very helpful. So without any UMP policies, without any forward guidance, an AIT policy, if it's credible, it would deter the economy sinking to deflation, and it would lead to a higher output. The same applies for the RE model as well. We have done a lot of robustness analysis. I would skip this in order to save time. And let me just conclude. So the first thing is that a symmetric target has a sizable gains compared to asymmetric target. Second, as I mentioned, unconventional policies are needed to offset some of the adverse effects from an asymmetric target, but they are not enough. And the third is that the makeup strategies, alternative policy strategies like average inflation or price level targeting, have favorable conditional short-term properties. There are some long-term costs for that, but with formulating these regimes, these makeup regimes as a temporary regime, we would harvest most of the conditional benefits in the short run, and while retaining the long-term benefits. of the standard policies. So in the future, we might find or analyze some alternative ways to address the forward guidance puzzle, for example, through loose commitment or regime change models. We would also analyze the role of fiscal policy to provide support when monetary policy is constrained, and also do some loss function based approach instead of the reaction function approach. And I'm happy to answer your questions and comments. Thank you very much.
Thank you, Zoltan, for your wonderful presentation. Now the floor is open for questions.
So, oh yeah, this does work. Sorry. So you find a flat Phillips curve, and you find a huge role for markup shocks. So, you know, in any new Keynesian model, the flatter the Phillips curve gets, the smaller the standard deviation of the shock in the Phillips curve, right? But when people estimate these models like Smets-Valters, what they do is they reparameterize the standard deviation of a markup shock, so it's actually independent of the level of price stickiness, for example. You know, but it's not a particularly reasonable procedure to do. These two things should be correlated in the prior. If you take the Smets-Valters estimates and you back out the implied level of variation in the underlying markups, it's crazy. And you know, whereas the AJ macro paper on optimal policy in new Keynesian models found basically the same point. And if you re-estimate these models, including measurement error, for example, measurement error in prices, measurement error mops up all of that variation that was previously mopped up by markup shocks. So if you do that, what would you find? Well, then suddenly you don't have these crazy markup shocks making AIT and price level targeting look bad, and you'd have a much clearer conclusion in favor of AIT and PLT. Yeah, sorry. Yeah, why not? Basically, that's the question. Sorry.
I think it's we did not say. I mean, that AIT and PLT is unfavorable. I guess we said it's quite favorable in the short run, at least, when the economy is hit by a large recession, and in the long run, it's also favorable at a little cost. But I get your point about the markup shocks. Yeah, it's always very hard. What is a measurement error and what is a real, you know, inefficient shock in the economy? Yeah.
Well,
So
it's easy to include measurement error in there. So, you know, just throw it in. And if it comes out significant when you estimate, then, you know, that's what the data says. There's no particular reason to have the same number of shocks as observables. Yeah.
Obviously not. I mean, we just wanted to stick to the standard Smets-Valters model to, you know, use a standard model in our estimation to focus on not on the model differences, but on the monetary policy difference, I would say. But obviously, I mean, with the measurement errors.
Yeah, well, you know, maybe you could follow Justiniano Primacheri Tambelotti 2013 AJ macro.
Yeah.
Instead.
Yeah, it's a good suggestion, and I don't see any reason why not doing that.
Okay, it appears there is another question by Ichiro Muto.
Hi, this is Ichiro Muto. And I think that paper is very interesting and successful to derive realistic policy implications, which supports ECB's policy changes yesterday. But I think that, you find that symmetric inflation target is desirable in your model. But I think that it is somewhat natural consequences because the model is symmetric, except for zero lower bound. Especially your model is based on symmetric Phillips curve. It is Calvo style Phillips curve. I'm wondering how the result will be changed when we introduce asymmetric Phillips curve by taking account of downward nominal wage rigidity, which will be a very realistic setup for European economies. So that is my question.
Yeah, that's a very, very interesting question, and we actually have it in the robustness analysis. So we experimented with a Phillips curve, which is like it's calibrated. I mean, such that in recession, when the output gap is negative, it's quite flat. At zero output gap, it's exactly at the estimated slope. And with positive output gaps, the slope increases quite radically. And here you can see the results with these long-term simulations. The same applies. So even more. So with an asymmetric target with a state-dependent Phillips curve, the cost in terms of output for an asymmetric target is even higher. Why? Because the state-dependent pricing creates more inflation bias. So now we have not just the ZRB bias, but an inflation bias.
So you mean even higher inflation target will be necessary if we consider the asymmetric Phillips curve? Is that right?
What I'm saying is that the cost of an asymmetric policy under this type of Phillips curve is even higher in terms of output, which is quite an interesting result, because partially we would think the opposite. In terms of raising the target, we also have it in the paper, not in this presentation, and obviously raising the target would lead to a lower cost of the ZRB. But because the cost of ZRB is quite small in this model, because of the small Phillips curve and because of the behavioral expectations, these gains are very modest, I would say, in terms of output.
Thank you. I'm sorry, but I would like to continue discussion, but there is always a trade-off between presentation time and Q&A. So we need to move on to the third paper. Thanks so much, Zoltan. The next
paper. Very much.
Thank you. So the next paper is by Glenn Schepens, the European Central Bank. The title of the paper is Climate Regulation, Farm Emissions, and Green Takeovers. Glenn, could you start sharing your screen?
Yes, sure. I hope you can see it by now.
Yeah, could you maximize screen? Okay, looks good.
Okay, perfect, great. So thanks a lot for having us in this session. So the paper I'm about to present is titled Climate Regulation, Farm Emissions, and Green Takeovers. It's joint work with Olivier, who's at the National Bank of Belgium and at Tilburg University, and with Klaas Mulier, who's at Ghent University. So given that Olivier and I are at the central bank, the usual disclaimer applies. So first of all, what's this paper about? So in this paper, what we try to find out is whether and how emission trading systems improve the emission efficiency of firms. And just to make sure that all of us are at the same page from the beginning, let me very briefly define, say, the two main terms in this question because they're very relevant for the remainder of the presentation. So when I'm talking about emission trading systems, what I mean is cap and trade systems. So systems in which a limit or a cap is being set on aggregate emissions of a set of firms, and then emission allowances are distributed among these firms either for free or via auctions or a combination of both. And these allowances can also be traded on secondary markets typically. When I'm talking about emission efficiency, what I simply mean is the production of a firm per ton of carbon emissions, and in the data we're going to proxy that by looking at the operating revenue of a firm per ton of carbon emissions. So this is going to be an empirical paper, by the way. So why is this question relevant? Well, for at least a number of reasons. So first of all, emission trading systems are a widely used regulatory tool to fight global warming. So if you look at the graph at the left-hand side here, you see that the number of ETS systems that are active globally has been steadily growing since 2005. So there was only one back in 2005, and we're up to close to 30 today. And similarly, logically, the percentage of global emissions that are covered by an ETS system have also been increasing steadily over time, from around 5% back in 2005 up until almost 20% today. So another reason why emission trading, why looking at this question matters, is that the EU ETS is the cornerstone of the EU's policy to combat climate change, which, I mean, especially from my perspective, that makes it extra relevant to look at. And a third reason is that the the reaction of firms to the introduction of such systems, which in the end implies an increase in input prices for firms, is ex ante unclear. So it's unclear ex ante whether firms would choose to improve their emission efficiency as a reaction, which is the focus of this paper, or whether they would, for example, choose to pass through these cost increases to customers, whether they choose to move production outside of the ETS area. All this isn't fully clear ex ante. Okay, so in this paper, we're going to be mainly focusing on the, or fully focusing on the EU emission trading system. So let me spend a bit of time talking about the EU ETS. So it is a cap and trade system that was launched back in 2005. And importantly, it operates in regulatory cycles, and a lot of the relevant parameters of the system are set at the beginning of each cycle. So, for example, the total amount of allowances that's being distributed among the firms, but also the free allowances that each firm receives, are all decided on at the beginning of such a regulatory cycle, such a phase. And we had a couple of phases until now. So we had the first phase 2005-2007, and the second phase 2008, 2012, the third phase 2013-2020, and now we're in phase 4. And in this paper, we're going to be focusing on this 2013-2020 phase. So why focusing particularly on this phase and not on the actual launch of the system back in 2005 to analyze the reaction of firms to these ETS systems? Well, the main reason for that is that until 2017, one could say that the European ETS wasn't super functional, mainly due to the fact that allowance prices were very low before 2017. So, and of course, ultimately, what such a system tries to do is to make firms internalize the cost of emissions, and obviously this isn't happening when prices are too low. So there were a couple of reasons why prices were very low at the beginning. So initially, when the system was introduced, there was a very generous supply of emission allowances, partly due to the lack of reliable information about actual emissions at the start, back in 2005, 2007. Then during the second phase, there was an unforeseen reduction in economic activity due to the financial and sovereign crisis, which suppressed demand and led to fairly low prices of emission allowances. And these low prices basically were there until the mid of the third phase, until reforms were announced in 2017 to tackle this problem of very low prices. So let's zoom in on what's happening during this third phase in terms of price evolutions of the allowances. So the graph on the right hand side here shows the price for emission allowances. So you see that at the beginning of this third phase, it's hovering around 5-6 euro per allowance for reasons that I talked about over the previous slide. So it was basically a market surplus of these allowances, and this made this lasted basically this period of low prices until European Parliament announced its position on ETS reforms that were proposed by the European Commission in February 2017. So there was a package of reforms that were announced, and I'm not going to go into the details of these reforms, but the important point is that all these reforms were aimed at reducing the supply of emission allowances in the future, and this effectively led to a strong price increase for these emission allowances. So where allowances were only fluctuating around 5-6 euros in the first 3-4 years of this third phase, they jumped up to 25 euros at the end of 2019, basically. So a very strong price hike. And in this paper, we're gonna analyze how firms react to this price increase, or put differently, we're going to use this tightening of climate regulation to study how carbon pricing impacts firm behavior. And to give you a sort of preview of our main findings, so the three main questions that we're asking in the end are: do firms improve emission efficiency, and how are they improving emission efficiency? And so we do find an improvement in emission efficiency once prices are jumping in 2017 via a reduction in emissions. And this is partly happening through a green acquisition. So polluting firms basically buying greener firms and acquiring. The second question we're asking in the paper is whether initial allocations of emissions matter, and we do find that they matter quite a lot. So more free allowances leads to limited improvements, although this is something that I won't focus that much on during this presentation. And then thirdly, another important question around these emission trading systems is whether or not firms move polluting activities outside of the regulated area. And here we can only partially answer this question in this paper, but at least we see that they're not doing this via mergers and acquisitions. Could still be that firms are partly doing this via existing firms within their network, but at least they're not doing this via new acquisitions. We contribute to the literature on the impact of EU ETS firms, obviously, but also on the literature on M&A. So I'm going to let me skip this so to be sure that I can focus on the actual empirical analysis in our paper. So I think it's quite obvious that we contribute both to a broad existing literature on EU ETS and ETS systems more in general, and how this impacts the behavior of firms, but also to a more broader M&A literature. The way we do this, so we look at data for EU firms that fall under the EU ETS. So we have firm year installation level data from the EU transaction log, from which we can see the total emissions for each firm and the number of free emission allowances that each firm receives each year. We match this data with balance sheet data from Orbis and M&A deal information from Zephyr. And in the end, we end up with about 4,000 firms from 30 EU countries, covering about 70% of the emissions that are covered by the EU ETS. So covering quite well the total EU ETS system. Now, what we do in terms of empirical setup, we're going to run a fairly simple difference in difference type of setup, for which two things are very important for us at the start. So first, the fact that the regulatory tightening or the price hike that we saw in 2017 was relatively unexpected. And if you look at newspaper articles from around that time, you do see that market followers and commentators find that this price hike or the new rules being implemented are a lot stronger and come a lot earlier than expected. And two, of course, we also need that not all firms are equally exposed to this price shock. And I'll come back to that in a moment. Let me first very briefly go over our exact empirical setup. So as I said, it's going to be a fairly straightforward difference in differences setup, where on the left-hand side, we have our variable of interest, mainly the emission efficiency at the firm year level. And then on the right-hand side, we have this post dummy, which is equal to 1 after 2016, so 2017, 18, and 19. The full sample period is 2014, 2019. And what we're most interested in is this beta 3 coefficient on this high exposure times post dummy, which will capture the relative difference of the impact of the price hike on high exposed versus low exposed firms. Now, how are we going to define these high exposed firms within our sample? Well, this is going to be firms that for which the allowance shortage is above the median of their industry. Now, what's an allowance shortage? It's very simply defined as the difference between the ex ante emissions of a firm and the free emission allowances that it receives. So the idea behind this is that if a firm receives a lot of emission allowances, so for free, so if basically all its emissions are covered by free allowances, then this price hike will not matter for this firm. While on the other hand, when a firm does not receive that many free allowances and has to go to the market to buy a lot of extra allowances to cover its actual emissions, then it will feel this price hike. So, and we calculate this allowance shortage before the actual price shock takes place. And just to quickly show you that this price shock could really have a material impact on some firms. With this graph, we tried to show, or it's a back of the envelope calculation basically on the potential impact of a 20 euro price increase on the EBITDA of firms in the high exposed group, so the red group, and the low exposed group, so the green group. So you see that for the median, this graph basically shows that for the median firm in the high exposed group, a price shock of a price increase of about 20 euros for an emission allowance basically corresponds with a reduction in EBITDA of around 3%. And this goes down to about 14% for firms in this high exposed group at the 25th percentile. So for some firms in this high exposed group, this is really a material shock, a material price shock that they're experiencing. Now, what do we find? Well, we first of all find that the emission efficiency indeed improves for these highly exposed firms, for firms that are highly exposed to this price shock. So if we look at the regression results in the fourth column, so on the left-hand side, we have our emission efficiency indicator, so operating revenue over emissions. And basically coefficients in these two last columns indicate that these high exposed firms see a relative increase in emission efficiency of about 5 to 8.5%, depending on the exact specification, in 2017, 2018. So we can also run a different but very similar setup where we, instead of using this high exposure times post interaction, we interact our high exposed dummy with yearly dummies. So the advantage of this is that it indicates that in the pre-period, the behavior of the high and low exposed firms was very similar in terms of emission efficiency, while indeed in 17 and 18, we do see strong pickup in emission efficiency for these high exposed firms. The large confidence intervals in 19 are due to the fact that we still have a very low amount of firms for which we have 2019 data, but we're currently updating the data to counter that. When we split up this emission efficiency indicator in actual emissions and operating revenue, so its two components, we do see that the improved emission efficiency is driven by a reduction in emissions, a relative reduction in emissions at these high exposed firms of about up to 5% in 2018. So that's also, I think, a very interesting takeaway. So then next, what we do in the paper is we try to find out how these firms are becoming more efficient. Like one way would be to invest more in green R&D, so to develop your own more green technology, let's say. But of course, that costs time, and potentially a more important and more quick channel to react could be M&A. So basically, brown firms taking over green firms. This could be a very interesting least cost and fast option to react to a large shock, which is this price increase in emission allowances. So in order to analyze that, we gather information on all acquisitions of regulated firms between 2014 and 2019. And what we're going to do is that we're going to look at each individual deal, and we're going to construct an M&A greenness indicator for each deal. And we do this by running a textual analysis on the deal comments that we get from our database. So this is basically running a textual analysis on the press statements and the like that were given for this particular acquisition. And we're going to measure the percentage of words in the text that are part of a green dictionary that we're using. Sorry. So what comes out of this analysis is that effectively high exposed firms seem to be more likely to acquire green targets after the price increase. So looking at these first two columns, we see that these high exposed firms increase this M&A greenness measure by 0.3 to 0.5 percentage points. So this is a material increase if you know that the average of this M&A greenness measure in our sample is around 0.7. So it's really quite a stark increase in the greenness of the deals that these high exposed firms are doing. And we see that this is especially happening for firms that are not on the carbon leakage list. And what's particular about these firms is that these are the firms that are not getting a lot of allowances for free, so which are especially strongly exposed to the price hike, basically. Now we have a bunch of additional results in the paper. For example, further sample split shows that this M&A greenness is especially happening in electricity sectors, which isn't that surprising given that this is a sector where very few free allowances are being granted to firms. We also show that high exposed firms after the policy tightening are more likely to do takeovers in within the EU ETS area. So this is in a way a positive finding, given that it indicates that they are not doing takeovers outside of the regulated area. So simply they're not simply moving brown production outside of the regulated area. So there's no type of leakage here. So all these results indicating that there seems to be a strategic change in M&A decisions after this tightening in climate policy, and that this is a way that firms address this more strict carbon regulation, if you want. So overall, main takeaways of this paper are that the price increase that we observe in the EU ETS in 2017 increased the effectiveness of this climate policy. So polluting firms became more energy efficient, they reduced emissions and not production, and at least part of the improvement seems to be driven by the acquisition of green firms by polluting firms. A second important finding, which I haven't spent much attention on during this presentation, is that the initial allocation of free emissions seems to matter a lot. So it's partially clear from the way we define our exposure variable, but we have a number of additional analysis in the text that confirm this. So and this could sound a bit surprising at first, because in theory allocation shouldn't matter from an efficiency perspective. If you look at the COS and follow-up papers there, of course this assumes an efficient secondary market. So part of the problem might lay there, but we don't have anything to say about that in this paper. The only takeaway here for the moment is that in practice, we do observe a limited impact of this price increase for firms that receive a lot of allowances for free. So that's it from my side. Thanks a lot for having us on the program once again, and I'm happy to take any questions on this.
Yeah, Glenn, thank you very much for your great presentation. So now the floor is open for questions. Okay, Jadish, please jump in.
Yeah, Daisuke, thank you. So Glenn, quite fascinating results. So if I may ask for a clarification question on the free allowances that were handed out, what is the basis for handing those free allowances out? Because maybe that will help understand your exposure variable a little more. And a related question to that, is I was wondering whether you have any correlation between specific sectors and your exposure variable. Industrial sectors, that is.
Yeah. So first of all, these free allowances, so they are decided upon within sector and basically within each sector. So put simply, there's a benchmarking exercise within each sector, which happens ex ante at the beginning of each regulatory phase. And say the most efficient firm within each sector is getting the largest amount of allowances for free. So so basically each firm within a sector is benchmarked against the most efficient firm in that sector. So if you're a very polluting firm, you're going to get less allowances for free, but this is relative within the sector. So there isn't any strong correlation there in terms of our exposure variable across sectors, exactly because of the calculation of these free allowances is happening within each sector. Then there's also a couple of sectors that get more free allowances than others, but this has to do with this leakage list. And if you're a firm that's on this leakage list, it basically means that you're a firm that's operating in a sector which the Commission sees as being particularly exposed to competition from outside the regulated area. So they're getting more allowances for free to counteract this potential external competition. But there's lots of discussion going on whether that's a good thing or a bad thing at the moment. So also I should add, in terms of these free allowances, this benchmarking, this has only been done since the beginning of the third phase. So in the first two phases, there wasn't any benchmarking exercise. One was rather looking at the actual amount of emissions from each firm, and was granting the free allowances based on actual emissions, which obviously didn't make that much sense because you're giving the most polluting firms most of the free allowances, which incentive-wise doesn't seem like the best solution, which is why the system was changed back in 2013 and now is operating via such a benchmarking exercise.
Thanks for clarifying.
Are there any other questions? Glenn, did you also look at the impact of this higher price in the carbon traded in emission trading system, the impact of this change on firm performance, like profitability and other firm indicators?
No, so for now we only focused on these efficiency measures. The only thing that goes a bit in that direction is, I mean, in the end, we see that at least their operating revenue isn't affected. But of course, this doesn't necessarily say anything about actual profitability. But we haven't checked that, but that should be easy to check.
Mm-hmm. And also, I'm very interested in the finding, but I'm more interested in the kind of the significance of the impact of the increase in the carbon price in reducing carbon emissions. So, for example, if we have a aggregate target of the level of CO2 emissions. And then if we want to keep operating revenues, then probably you would be able to calculate using back of envelope calculations how much the carbon price should increase to reduce carbon emissions.
No, yeah, sure, that's true. One could try to do these back of the envelope calculations. On the other hand, there's also a lot more very sophisticated models out there. I think by now, macro models that try to tell you something about the optimal price of carbon emissions or carbon taxes to offset any social welfare losses of these of emissions and of pollution more in general. So I mean, probably these are more suited to make these type of estimations. And plus, also the prices that come out of these models are typically a lot higher even than the prices we see nowadays in these markets. It easily goes to prices of, I mean, ranges are large, but anywhere between say $50 and $100 per emission right seems to be more or a better price for these types of emission allowances than what we see nowadays. So but we refrain a bit from making these estimates, given that we feel that we don't have, say, a proper model in place to make these type of guesstimates, I would say.
Yeah, so this is just my comment, and so I think your result on M&A is super interesting. And so if you have data on green investment, I'd love to see the impact of the price increase on green investment at the farm level. So I would imagine that as the carbon price increases, then there is more greater incentive for farms to invest in green technology. So
definitely, definitely, that's super interesting. So there's two things there. So one, that's typically not that easy to measure. One could look at patents and the like, but if you do that, it's also more of a long-term process, I think. So I mean, we now saw this price increase for the past 3 years or so in Europe. I think one could start looking at that now potentially, but I wouldn't expect to see like immediate reactions back in 17, 18 on that or that popping up immediately in the data. But in the long term, I agree that is something super interesting to look at. Thanks.
Yeah, thank you. Okay. So now we move on to the final presentation by Jadish Tripathi, Bank of England. The title of the paper is Star Charities, Director Networks and Farm Performance. Jadish, the floor is yours.
Daisuke, can I check that you can hear me clearly and see the screen?
Yeah, yes, perfect.
Yeah, so hi everyone, I'm Jagdish Tripathi from the Bank of England. And to begin, I would like to thank the organizers for this opportunity to present some recent research on the effect of director networks on firm performance. This research is jointly conducted with Salim Bahaj, Andy Blake, Angus Foulis, Andy Haldane, and Gabor Pinter, all of whom are at the Bank of England, and some of them I believe are in the call. And the usual disclaimer applies. What follows is not meant to represent the views of the Bank of England or any of its policy committees. So the paper I'll present today studies the role of social capital or social interactions on firm performance. Before we get into the results of the paper itself, we would like to motivate the role of social capital on firm performance via simple diagrams. What you see on the screen is a very simplified version of what a firm does. It combines inputs such as physical and human capital to produce output. There is a growing recognition of a missing input in this diagram, which plays a role in a firm's economic output. And that missing input is social capital. Now, so what do we mean by social capital? To understand this form of capital, consider the board members or directors of a firm. In this illustrative example, the firm has 3 directors, D1, D2, and D3. The firm is connected to other firms through its directors, in this case to firm 2 and firm 3, through the directors D2 and D3 respectively. These interconnections between firms via the directors have economic value, which we call social capital. For instance, a rupture in the link between firm 1 and firm 2 via D2 is likely to have negative impact on either firms if D2 was to leave one of their boards. And this could be because of multiple channels. These firms may both be benefiting through this link by becoming business partners or by getting access to better suppliers, or there might also be better knowledge transfer or better transfer or better learning through the link intermediated between firm 1 and firm 2 via D2. The final illustrative figure shows the type of analysis we do in our paper. We ask, can we measure the role of social capital if a new firm 4, for instance, was to get connected to firm 1 via D1? In this case, D1 was not connected until now. This connection is clearly not exogenous, and any effect on firm 1 after D1 joins the board of firm 4 is not going to be the causal impact of social capital acquired by firm 1 when D1 joins firm 4. However, we propose an alternate setting which we can use to test such connections and to make causal claims regarding the existence of social capital. And more specifically, we propose studying the economic value of social capital via charities. And why do we consider charities? First, charities are not for profit. And particularly in the UK, by law, they must have a charitable purpose. And this purpose is such as the prevention or relief of poverty, advancement of education, health, arts, and culture. That is to say that a charity's purpose is orthogonal to a firm's economic objectives as we understand them. And you also, at the bottom of this slide, you also have some examples of some of the charities in our sample. For instance, Eden Trust supports public education and research in the natural world, and Business in the Community is a charity focused on corporate responsibility initiatives. Now let's go back to the earlier figure and see why charities are interesting to study social capital. Now imagine if firm 4 in this example was a charity. That is, D1 from firm 1 joins a charity, because of which firm 1 and firm 4 become connected. The social capital acquired by firm 1 with this new link is arguably exogenous, assuming directors get invited to charities in a quasi-random way. And the second important factor is that when firm 1 gets connected to a charity via D1, it doesn't acquire any physical capital. So that is, it acquires social capital in a quasi-random way, and it doesn't acquire any physical capital, which allows us to make causal claims on the economic impact of the social capital acquired by firm 1 when one of its directors, D1, joins a charity. And I'll be a bit more specific on why we believe joining a charity leads to the acquisition of a lot of social capital. So having established, so we are looking at we want to establish the economic value of social capital, and we propose doing so via charities. Let's look at a very brief summary of our results. So in this paper, we document new facts around the network of firm directors in the UK. First, we find that a significant proportion of the most central firms in the UK are social charities. We call these central charities as star charities. And what we also see is that the directors of these star charities are of a very high quality. They are highly skilled. We document a positive effect on firm performance when a firm has a director joining a star charity. This is seen in a positive growth in scale, turnover, employment, and labor productivity. And secondly, these effects are heterogeneous. That is, they are stronger for smaller and younger firms, and they are asymmetric and persistent. We'll be going into these ideas during the presentation. Finally, we document a significant improvement in the quality of a director's connections when they join a charity. This is equivalent to the firms they belong to acquiring social capital. And as I had mentioned earlier, joining a charity leads to a firm acquiring a lot of social capital, but not physical capital. We also do not find any evidence of joining the charity network leading to any bank-firm relationships. So in end, what we see are two events taking place at the same time. When a firm has a director joining one of these star charities, it acquires a lot of social capital. That is, the director joining a charity acquires a lot of high quality connections. And in turn, in subsequent periods, we see a positive impact on firm performance. So as a one-line summary, we use charities to establish the economic value of social capital embedded in the director networks of firms. So that was a fairly brief but a whistle-stop tour through the main results. So what I'll do next is to introduce the data and to describe the novel facts that I mentioned in more detail. We have a very brief literature review in the slides that I won't be going through in the interest of time. So in this section, in the institutional background, we will get into the novel facts with more detail. So here is a brief description of the data that we use. So we have data on board members for the universe of UK firms from 2000 to 2014. And we have unique director IDs, which allow us to track directors across firms, which then allows us to create a network of firms. So two firms are connected. As you saw in the diagrams, we say that two firms are connected if they share a director in their boards. And by tracking these directors across different firms, you're able to create a network of firms connected via these director connections. And in this network of firms, we identify central firms using two different measures. One is Betweenness Centrality, which is based on the total number of shortest paths passing through a vertex, where a firm is at a vertex, or through a first order degree centrality, which calculates the total number of nodes that pass through a particular vertex. And using these two measures, we use an arbitrary cutoff of 500 most central firms, which leads us to create a list of roughly 800 firms, which we say are the most central firms in the UK. And so we have created a network of firms, and in that network of firms, using these two measures, we have identified a list of the most central firms in the UK. And as you see in the, we also have a lot of information on the firm characteristics and director characteristics that will be useful for our analysis. So what do we know about these most central firms in the UK? A surprising fact that came out from this data is when we compare this list of firms to the official registry of charities, we find that a very large proportion of the UK's most connected firms are also charities. And as you see in this figure, which is a proportion of most connected firms which are charities, it's around 20% and quite stably so throughout our sample. So a very large proportion of UK's most connected firms are charities. And as I mentioned earlier, so there is a very large list of charities, and in the list of most connected firms, 20% of those connected firms are charities. We call these connected charities as star charities. And as mentioned earlier, these charities or these star charities are not for profit and have meager balance sheets. In this slide, you see a histogram of the total assets managed by these star charities, the average value of which is roughly £17,000. So these star charities are not for profit, and they don't have they can have a large income, but they have very small balance sheets. The total amount of assets under a star charity is just £17,000. But the total asset managed by directors of star charities is an entirely different beast. So you have a charity which manages only £17,000, but if you add up the assets managed by all the firms that the charity directors are a part of, you end up with a much higher number. So what you see in the figure on this slide in the darker shade is the proportion of total assets in firms with at least one star charity director on its board. And the way we get to this proportion is we add up the total asset of all the firms with at least one star charity director and its boards, and divided by the total number of assets under control by UK corporates in a given year. So for example, let's say for 2004, the total assets adds up to 1, and the darker area adds up to roughly 0.43. So this is the total assets under firms which have at least one charity director as a board member. And so the proportion of assets managed by directors in star charities is a number that fluctuates from 40 to 60%, and it's slightly higher than 50% on average. So what we know is that these star charities have meager balance sheets, but the directors of these star charities manage a large proportion of the total assets under the UK corporate sector. And the final fact is about the directors of the star charities themselves. What we see is that they are highly skilled. Now, if you compare the average characteristic of a director of a star charity in column 2 with non-star charity directors in column 3, you find very large differences. What we see is that such directors hold a greater number of directorships at any point in current jobs, have a higher total cumulative number of jobs, almost 4 times that of directors not in star charities. They have more they have experiences in greater number of industries. They have higher total cumulative years of experience, and have been part of a greater number of firms at the time of both firm creation and at the time of firm birth. On an average, you see that there are, for each metric, charity directors are almost 4 times that of non-charity directors. Columns 3 and 4 show that these differences are highly statistically significant. And based on these 3 facts, we ask, what is the effect of firm performance if one of the firm directors joins one of these star charities? Because once they join a star charity, imagine if you're an IT firm and you join a star charity, you're again meeting other directors in this star charity who are of a very high caliber and of a very high skill level, which is akin to your base firm, your base IT firm acquiring a lot of social capital. And we want to identify if acquiring this social capital leads to better firm performance. So to study firm performance, what we do is we compare changes in firm performance upon joining a star charity against matched firms using course exact matching, because we find that firms when they have a director in a charity, they have characteristics that are not similar to an average firm in our sample, because of which we use a matched estimator. And matching is based on firm size, leverage, proportion of fixed assets, and other variables. We have roughly 6 variables for which we find differences between firms when they are when they have a director in a star charity, and as opposed to firms which don't have directors in star charities. And our empirical specification is fairly standard. We regress firm level outcomes on a dummy, which indicates whether a firm is in a charity, while using weights that allow comparison across matched firms. So this slide shows what the differences and means for matching variables between firms firms within and outside the charity network are. So this slide is just meant to motivate the matching technique. So I'm not going to go into it in detail today, but let's see what do we find using our matched estimator, which you see in this table, where along the columns you have different firm level outcomes, and what the estimates show is the matched estimator using course exact match. We find that, as you see in columns 1 and 3, we find that firms undergo faster growth in asset total size, assets, and sales. And in column 7, you see that they also undergo faster growth in employment. We find no evidence of a change in leverage, but this is likely driven by comparable increases in firms' share growth and liabilities growth. So we see an improvement in firm scale, firm turnover, and firm employment as a consequence of having a director becoming a board member in one of these star charities. We find that this effect, so this is a bit more nuance on the effects on firm performance. The firm performance is, first of all, heterogeneous in the sense it is stronger for younger and smaller firms. It is symmetric, since leaving the charity leads to relatively lower growth in assets and sales after a director leaves one of the star charities. And we find that the effect is persistent, where we show that using local projections, firm performance is persistently high up to 4 years after joining the charity. In results that I won't be going into in this presentation, we find that having a director join the star charity does not lead to new bank firm relationships for the firm, which suggests that the results are driven by the social capital acquired by the firm. And doesn't lead to any acquisition of physical capital per se. And what we will do next is to provide a bit more of a direct evidence in this increase in social capital when a firm has, when a director joins a star charity. And to see a more direct evidence of a change in social capital for a firm, what we do is we study changes in a director's connections when they join a star charity. And a director's connections is the total number of other board members they are connected to in all the firms they are directors of in a given period. So imagine Daisuke. If Daisuke is a board member in 3 different firms and he knows 15 other board, and he shares these board members with 15 other directors, the total number of director connections for Daisuke is 15. And what we are interested in is the composition of directors that Daisuke meets in his 3 firms. And Daisuke might meet 3 types of directors. And these 3 types of directors are, firstly, star charity directors. And a star charity director is quite simply is a director who is a member of a board member in a charity, which are the red colored directors in this illustrative example, that directors in charities themselves. And Daisuke might be co-directing with other connected directors. And these are directors who co-direct with charity directors in non-charity firms. In this illustrative example, they are the blue colored balls. Or Daisuke might know other unconnected directors who are directors without a direct link to a charity director. That is, they are neither charity directors, nor do they direct a firm with other charity directors. And there is a quality gradient in the sense that a charity director is of a higher quality than a connected director than an unconnected director. So, and we ask, so what happens to a director's connections when they join a charity? Or let's say, what happens to Daisuke's connections when Daisuke joins becomes a board member of a star charity itself? Using a matched estimate akin to the one followed for firm performance, we find that director connections evolve at a slower rate when a director joins a star charity. That is to say that the number of connections that a director knows doesn't grow faster. It actually slows down after they join a star charity. While you might think that this is sort of a negative result on social capital, what we find that there is a change in the type of people they meet after they join a star charity. In particular, we find that a director is more likely to meet connected directors who are of a higher quality than other unconnected directors who are of a lower quality in periods after they join a star charity. So in summary, what we find that directors upon joining a charity form new connections with other higher quality directors. This is over and above the other meeting other highly qualified charity directors. So they meet new charity directors, but over and above that, they also meet other high quality directors. And this improvement in the social interactions or connections of a director has implications for the social capital for their underlying firms, which, as we have seen, undergo better performance in periods after their director joins a star charity. So this brings me to the end of my presentation, and I'll just summarize our main results. So we look at the network of firms in the UK connected through their directors, and in this network, we identify the most central firms in the UK. And our first surprising finding is that a significant proportion of the most central firms in the UK are social charities. And we also see that directors of these star charities are highly skilled themselves. Now, given that these charities are not for profit and getting invited, something that needs additional work, but under the assumption that joining a star charity is a quasi-random event, we use this event to study the effect on firm performance for firms who have a director recently joined one of these star charities, we use a matching estimator to document positive effect on the firm's scale, turnover, and employment and labor productivity. And we find that these effects are heterogeneous. They're stronger for younger and smaller firms. The effect is symmetric, that the director leaving a star charity leads to lower growth for the underlying firm, and the effect is persistent. And finally, we also document that this improvement in firm performance is concomitant with an improvement in the firm's social capital, because we see that when a director joins a star charity, they meet more skilled directors. There is an improvement in the quality of their connections, and we do not document any evidence of joining the charity network leading to new bank firm relationships. So thank you very much for your attention, and I look forward to your questions.
Thank you very much, Jadish, for your great presentation about new findings on charities, social capital. So now the floor is open for questions.
So, hi, Jadish, this is Glenn. Interesting paper. I have one question and one comment. So the first question is on, say, the selection of directors into these star charities. I mean, I can imagine that like existing directors would in this charity already, they are looking for high quality people, and they're all, I mean, they have a very good network, so they kind of, one could assume that they know where the good people are and what the up and coming firms are. So this could lead to some selection problem here, that actually these star charities are selecting directors of firms that they expect to do very good in the next couple of months of years. And I know this is very hard to tackle, but what's your, how are you handling that in this paper? And then secondly, a comment on the heterogeneity in your results. So you find stronger effects for smaller and younger firms, and if I remember correctly from one of the previous slides, also for younger directors there seems to be a stronger effect. And at first sight, this seems, I think, consistent with, there are some papers out there showing that directors that are too busy, basically, that are involved in too many different boards, they actually can have a negative impact on the performance of their firm, because there's only 24 hours in the day for everyone, so they can only do a limited number of things. And this seems to be very much in line with what you're finding here, because it's reasonable to assume that these younger directors are less involved in a broad range of activities than the more older ones, potentially. So that could be an interesting thing to have a look at, a way to explain this heterogeneity potentially.
Daisuke, should I respond first? Yeah.
Yes, please.
Yeah, Glenn. So first to the question, which is whether these directors, because they're also highly skilled and they would know about other directors and who the up and coming stars, be the directors or firms are. So that is very important for us. And so we do match along dimensions which would capture some of those up and coming stars, because we match upon asset growth, firm size, firm age, also director quality at the time of joining, average director quality of the firm itself. So rather than sort of outsourcing all this concern of some hidden variable that is driving everything, rather than outsourcing it to the matched estimator, what we haven't done it yet. We realize it's very important that because there is an underlying assumption that being invited to a charity is a quasi-random event, where question sort of challenges that notion. Why should it be a quasi-random event? So what we plan to do is to document anecdotal evidence, because these are charities which are very, they also have their structures, they also have their governance policies. Maybe the simplest way, the direct way for us to tackle this question is to document evidence on how you become a charity director. And that's a part of that's on our to-do list, to document that you do get invited on a fairly random basis, or to at least document how do you get invited to one of these charities. So
that would be very interesting to see.
Yeah, and your comment, point taken. For us, the younger director result was also, we had not thought of it along in the direction you said. So we'll be happy to get into that literature as well, to cite some of the literature on director bandwidth and see if that is consistent with the stronger effects for younger directors. Thanks for that.
Jadish, I have one small clarification question. So what's the difference between star charities and non-star charities? And also, are there any findings on joining non-star charities about farm performance?
Yeah. So non-star charities are essentially normal charities which are not highly connected. So for us, the starting point is the list of which was the first surprising finding. When we look at the list of most connected firms, what popped out to one of our co-authors was, most of them look at it's 20%, but most of them look like charities. So a charity which is in the list of the most central firms is a star charity, and all other charities would be, let's say, non-star charities. And so what we could do as an exercise is to pick a random list of charities and look at the director connections and whether joining because the entire story here is about being connected to highly skilled directors, which may not be the case for an average charity. Maybe that could be a good placebo exercise, that what matters is meeting these really highly skilled directors and these charities. That's an idea. Must be transparent. We had not thought of, but it sounds like a good placebo exercise.
Thank you.
Thanks, Les. And thanks again for having us. Sorry, I'm not sure if there are any.
So it appears, are there any other questions? So I think time is almost up. I wish I could continue discussion, but it's been a great session consisting of wonderful 4 papers and 4 presentations by Takuji, Zoltan, and Glenn and Jadish. Thank you very much for your contribution. And for audience, thank you for joining us.
Thank you.
Thank you. Bye.
Okay, next time I will see you. I wish I see you in person. I hope.
Thank you.
Bye. Thank you.
Bye.